Thank you, Keisha. Welcome, welcome. All right. All right, so we've done this already. Welcome everyone to the Homeownership Made Easy First Time Home Buyers webinar. This is actually the first time I've done this version of the webinar. For those who know me, you know I'm a mortgage broker and I'm very passionate about helping moms get into the industry. So I usually cater my events to moms. And so this time I'm partnering with Marsha, who is a mom also. But I
I
was like,
am.
let's just open it up. Let me, it's a new season, it's spring. Let me not let
That's
anyone
good.
feel left out. So thank you for taking the time to join us. I'm super excited. Feeling a little rusty. I feel like I haven't done this in forever, but I am so grateful that you are here with us tonight. And so let's jump right in. All right. I found this quote online. Owning a home is both is a keystone of wealth, both financial affluence and emotional security. And so, you know, for most of us, I know for myself and my circle, we were never introduced on the concept of building wealth, right? And so owning property is actually one of the pillars in creating wealth for your family. And so when you'll hear my story in a couple slides, but you know, participating in the game of real estate can truly change a trajectory of your family's financial future, but also in like your own stature, your own proudness, right? And so that's why I do these types of events, because I want everyone to know the information so that they can make an informed decision in order to make that decision for their family. And of course, we are here to help you do that. All right. So today we're talking about homeownership made easy. In no way, shape, or form am I implying that buying real estate is easy, right? But what it is once you make a decision and you gather the right information, put in the work, the process is easy. I think we overcomplicate things sometimes. And so we take information from all these different sources, we get confused, and then we take no action. My goal is to simplify the process, right? I will use, here and there mortgage jargon, and I know Marsha will share too, but I want to simplify the process because when you understand it, you understand it's easier for you to make that decision. So our goal is to provide you with insight along with the information that you need to begin your journey to home ownership today. All right? Today. I'm an action taker. Once you're here, this tells me that you're ready to make a move. So we're gonna be talking, all right? We're gonna be talking very, very soon. All right. So a little bit about me. I am a mom of one 9-year-old boy, Mr. Mateo, aka Prince Tay. I am a real estate investor, been a mortgage broker for over 20 years. I'm also an author and legacy coach because I believe that in everything that we do or anything that I do, it should be Kaladin. All right. Anything I do, it should be with the intention to help the betterment of your financial future. So I do a lot of things. I'm a serial entrepreneur. I also do financial coaching for moms because again, buying real estate is great, but if you don't know how to manage your money, it's not really going to work for you. It may actually work against you. So we have to have that holistic conversation and ensuring that you know how to maximize your dollars and invest your dollars in vehicles that's going to allow it to work harder and not work harder for you than you can work for yourself. All right. And so, how I got into this industry started back in my own childhood, where I'm the eldest of three, raised by a single mom who did it all and did the damn thing, Miss Andrea. But she had me at a very early age, so we kind of grew up together. And so I had firsthand knowledge of how challenging it was to not only, do what you have to do for your children to make sure that they're provided for and comfortable and have everything that they need, right? We had wants too, but we had everything that we needed. Um, but I noticed that she wasn't able to do everything for herself. And so I was like, for my first decision was I ain't having no kids. All right. And so I didn't for a long time. And then God had a different plan. And so here he is. But I really decided that I was going to just do things differently than how she did it. We grew up in social housing, right? And so we know that the system is designed to keep you stuck, right?
Yeah.
And again, I just decided that I didn't want to be in that hamster wheel of life. And I made a decision that I was going to leave the coop at the age of 20. I made the decision at 22, and by 23, I was ready to move. So I knew that I didn't have very much knowledge of the industry. I just knew the basics. I knew that if I was paying rent, I was paying somebody else. But if I was paying a mortgage, I was paying myself. That's all I knew. I had no idea about how to get a mortgage. I don't know I don't even know how I qualified, to be truthful. Mind you, back then, it was over 20 years ago, I bought a two-bedroom condo in the heart of Toronto. Well, not the heart of Toronto, but the heart of Toronto. It was at Islington and Finch. Very big, spacious, old-time condo for $100,000. And as you know, in Canada, we can purchase with as little as 5%. So I only had $5,000. I don't even know where I got the closing costs from, to be honest with you. But that simple decision truly changed the trajectory of my life. And that had a ripple effect in my mom's life. A year later, 2 years later, I became a mortgage agent. And then within the first year of me becoming a mortgage agent, I helped my mom to get her first property, right? Something that she had never thought that she could do. And so this is why I'm so passionate about providing the information, the resources, the tools, and the support to help transition people from rentership to ownership, because it can be done as long as you have someone to support you. All right. So what do I do as a mortgage broker? In simple forms, I work for you. Although I do have to correspond with the bank, I do have a fiduciary duty to ensure that the clients that I refer to them are employed, have fairly good credit, have their down payment from, reputable sources. I really work for you. My heart is to help you, right? Because a mortgage it can be a complex thing. And mortgages are not one size fits all, which is why as a broker, I can provide you with a lot of options that can fit your customized situation. Everyone's household is not going to be the same. Everyone's finances is not going to be the same, right? And so with a broker actually works with you where you are and helps you to transition to where you need to be. Traditional lending styles don't typically work like that. It's either you're ready right now when we approve you, or come back and see us when you think you are, right? I have relationships with various types of lenders. Like there's more than the bank, right? Just like there's more than No Frills, there's more than Walmart. There's multiple options in the lending industry. We work with banks, we work with credit unions, trust companies, equity lenders, monoline lenders, which are lenders that work specifically with the mortgage broker community, which means that they act like banks, but they're not actual banks because they don't have a facility, right? But they lend based just on the same exact rules and regulations as the bank, right? And so again, working with a mortgage broker, you have that opportunity to access different options. All right. I help you with purchasing. If you are an existing homeowner, I can help you with leveraging your equity to buy more real estate, because that's actually the game plan. You don't want to buy one house, you want to buy multiple houses, right? And so wherever you are in your journey, I will work with you to create a blueprint to help you get to where you need to be. All right. I feel like I'm talking a lot. Is anybody there?
You're doing just fine.
Okay, thank you.
Yes.
One person's here. Thank you.
Yes.
And so just to give you a visual of the comparison, this is just a snapshot or of maybe a quarter of the lender options that we have. But if you go into the bank, we have all of these, but with the bank can only offer you what they sell, right? And so that may not be able to serve where you currently are. And I can guarantee you, they're not going to work with you to rebuild your credit. They're not going to say, do this, this, this. They don't do that. They're on their course of action is volume, get you in and just build from there, right? So working with a broker, you have a customized experience that can truly help you to create that blueprint to help you build wealth by leveraging real estate. I think you're up next, Marsh.
Well, here we go. Good night, everyone. I'm hoping everybody is doing well, and we're all full from having our dinner. Is that so? Can I hear if anybody is there? Oh boy, it's really quiet tonight, Siobhan. But in any event, Oh, you're here. Okay, good. That's good. That's good. I just wanted to quickly introduce myself. My name is Marcia Walters. I am a realtor with EXP Realty, and I assist Siobhan in finding or helping you find your first home or your new home. My role is basically dependent on you seeing Siobhan first. And once your pre-approval is a go, then the fun begins. I am a full-time realtor, so I will always be at your service. I do sleep and I do have 4 kids. But outside of that, I am here to assist you with this journey. When you hire me, you hire a team of realtors at EXP. We all work together to ensure that the end goal is met, which is getting you into your home. A lot of times people ask me, how do you get paid? And just to let you know, my fee to you as a buyer is free, so you don't have to worry about how I'm compensated. I am here to serve you. I also promise to help you as much as I can reach your goal. I am very hardworking, and one thing I will always do is tell you the truth, because really and truly, at the end of the day, we need to know what it is that we need to do in order to be equipped to get into real estate. Next slide. Next slide. Next slide. Right. So at EXP, we service clients worldwide. So it's not a brokerage that only works in Toronto or GTA or Ontario, it's worldwide. So if you want to buy in Jamaica or any other lovely place, I'm your girl, hit me up. We can get that done. We're the largest real estate brokerage and a premier cloud-based brokerage as well.
Awesome. Thank you, Marsha.
No problem.
All right. So, again, if you guys have ever been to any of my other webinars, you know that I like to give homework, right? Well, we're going to actually do it here, but I like to give something to do, right? Action. I'm all about action. And so, are you guys ready? Drop a 1 in the comments if you're ready. I promise you won't sweat. This is going to be fun. That's in, you ready? Awesome. Okay. So the good book says, we must write the vision and make it plain, right? And because, I can't really see if you're going to actually write it, we're going to type it tonight, okay? We're going to type it and we're going to drop it in the comments. So here's my question for you. Oh my God! You just came into some money. $1 million to be exact. This is where we're going to activate our reticular activating system. And we are going to visualize our property wish list. Where you want your property, what type of property you want, how many bedrooms, what is the aesthetic, is it just a single family, is it a investment property? I want you to think about it. I'm going to give you about 5 minutes. No, I'm going to give you about 2 minutes to think about what type of property you would buy, because you just come into money. And this is actually, it's an assignment, but it's actually a test too. I'm looking for to see what the responses are like, but I want you to drop it in the chat. All right, drop it in the chat. Let me know what type of property you're looking for, where it is, some of the the little, what do you call those, the little shiny stuff, like things that you want. Maybe you want a pool, maybe you want a double garage. All right, so just think about it for a minute and then drop it in the chat, and let's have some fun. Let's expand our mind, because we are ready to be first time home buyers. Yeah, as my sister would say. Grand Valley, 4-bedroom, 2-car garage, chef kitchen. Okay, and we are coming for dinner. Okay, Marsha, you ready? Thank you, Christopher.
I'm in. I'm in.
Okay.
Chef kitchen. Wow. Okay.
Mm-hmm. I love the details. I love it.
Yes.
Anyone else? Oh, hold on. Let's see. Terry says 5-bedroom, 3-bathroom townhome, type open concept in the suburbs with high-rise ceilings, a pool, and a garage. Ooh, I love it. Love it, love it, love it.
Yeah. I'm with Terry.
Mm-hmm. I'm a
Yeah.
suburbs girl too. I like the city,
Yeah.
but I'm a suburbs girl. I like both.
Right.
I like
For
both.
sure.
I'm not sure about the pool. Can't really swim, but we'll figure it out.
Yes.
Keisha says investment property somewhere east, possibly a duplex or triplex. Awesome. I love that. Daslin says, I hope I'm saying your name correctly, Daslin. 4 bedrooms in Kitchener, 2-car garage, open concept kitchen, all white. Then
Wow.
okay, all white. You just captured my heart, Daslin. Give me all white
Mhm.
everything, okay? Rem- remaining on an event, then remaining on an investment property. Ding 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 ding. You get a prize, okay? Let's go. Anyone else? Marsha, you can engage. Talia
Yeah.
says a 4 bedroom house in Bowmanville, 2-car garage, then off to the island to purchase property. Yes, love it, love it, love it. Gifty says 4 bedroom single family home anywhere in North York. Okay,
That sounds good.
that sounds good, right? Donna
Yeah.
says 4 bedroom, 3 bathroom on in Caledon with a jacuzzi with the front and rear patio. Love it, love it. You can tell Donna likes to relax. All right. Anyone else? I'll give it 10 more seconds. Stella would like a 5 bedroom, 3 bathroom home. Okay. Terry says yes, definitely an investment property too, and a vacation home back in Jamaica. Love it. Love it. Love it. Love it. So what I want you guys to know, what I just got you to do was to actually just wrote your vision. So what I'm gonna task you to do now is to take a screenshot of what you typed, or you can write it pretty, or what I would do, I would go into Canva and create a nice little web tile. I want you to screenshot it or create an image and put it as your screensaver on your phone. In addition to that, you're going to put a date as to when you want to own that property. Key things, there are a couple people who realize that that's $1 million, right? And so that's an opportunity to leverage, because in truth, that $1 million will probably get you 5 different properties, right? In the right spaces, right? And you can leverage a mortgage to create your legacy plan, right? So that's awesome. Marsha says you can find me in Vaughan, 4 bedroom, 3 bath with a basement. Yes, mine. I like Vaughan too. It's a little cumbersome now, but I like Vaughan.
Yes.
I like
Yes. I
Vaughan.
like one.
All right, guys. So take a screenshot or write it out and put it as your screensaver on your phone. It starts in the mind. Everything we do in life starts in the mind. We make a decision, we visualize the decision, we write the decision, and then we activate the decision. All
Mhm.
right? So I'm looking forward to all those mortgage applications because we know the $1 million is coming. We don't know where it's coming from, but it's coming. And I'm here to serve. All right? Was that fun, guys?
That was fun.
So thank you, Marsha.
I enjoyed it.
So why real estate? Real estate, it's one of the most secure investment tools that are out there. And it's actually the only investment tool that is tangible. There's other ways that you can invest your money, for sure, right? There's stocks, there's mutual funds, there's crypto, there's all types of things. But can you actually see, touch, and feel those things? No, right? But real estate, you can. And this is why I really, really love it. And so, anybody who can get into it, I encourage you to explore the option, right? Talia says, speak what you seek until you see what you said. Come on now.
Come
We
on
have a
now.
church in here
Come
tonight.
on
Let's
now. Come on.
go. But why real estate? As I mentioned to you, one of my decisions into getting into real estate was really because I understood the basic concept of paying yourself first, which is the money rule 101, right? Every pay that you earn, every time you get a paycheck, you should be paying yourself a portion of that paycheck because you've earned that, right? So why not invest your rent money, your shelter money, because everyone needs to live somewhere, into real estate? What are some of the benefits? What are some of the comparisons? When you're a renter, as I mentioned, you're paying the landlord and building their legacy, right? Or you are paying yourself and investing in yourself, building your wealth. Your money in rent will finish quickly. So remember I said I had $5,000, and if I had if I not purchased a property, that $5,000 in rent would have blown in the first year, and I would have had nothing to see for it, right? And so that $5,000 yielded me a $40,000 return on my investment in 4 years back in 2000 and no, early late 90s. Okay, I'm not aging myself, right? $40,000 by that simple $5,000, right? So you see that not only are you paying yourself, right, and paying down your mortgage, the market also appreciates and your money can grow, right? So it's also, I like to call it like a forced saving. So for some people, they may find it difficult to pay all of their bills, take care of their children, do all that they need to do with their paycheck, and are not able to save. But if you have a home, you're literally saving. It's like a savings account every single month because you are paying yourself in that mortgage payment. A portion goes to the interest and a portion goes to the principal, which belongs to you. All right. No more savings. No, I said no. So your money finishes, no savings in renting, and you have restrictions. You can't really, you can, kind of zhuzh up your place, but you can't make any major changes to make it yours. Whereas in your own home, you have the freedom to do what you want, right? You have the freedom to leverage the property. You can do all types of things when you own your home. And this is why, as again, I big advocate for investing in real estate. All right. So what qualifies you as a first-time home buyer? There's been a lot of misconception that only first-time buyers can purchase with 5%, which is not the truth anymore. Years ago, they did make that change. Anyone can purchase as long as it's a home that you plan to live in. You could be purchasing your third, your fourth, your 10th property. As long as you are going to live in that property, you can purchase with the minimum of 5%. But what qualifies you as a first-time home buyer? If you've never owned a property before, of course. If you have not owned a principal residence, so that means a property that you live in 4 years prior to the time you are making your new application, right? So you could have owned a home 10 years ago, something happened, and you sold it, and you had to rent for a few years, and now you're ready to buy again. You do qualify for the first time home buyer status, and I'll tell you again what that means later on, or what you get for that. If you've owned a home yourself, but your spouse has not, you can then purchase together as first time home buyers. And then lastly, if you are a single parent who has only owned a home with a former spouse, so if you do get divorced or separated, you then can repurchase and qualify under the first time home buyer label. Okay. Any questions? First-time home buyer incentives. So right now, the government of Canada has 3 in particular for first-time home buyers. There's the home buyer's tax credit, the home buyer's plan, also known as the RRSP withdrawal plan, and the first-time home buyer incentive program. In addition to these programs, most governments offer a land transfer tax refund. So again, in any property that you purchase, whether it is a resale or a new construction, the government always steps in to get their piece of the pie. And so as a first-time home buyer, you are eligible for a credit of up to $4,000. So depending on the size of the property or the size of the size of the property will determine how much of that credit you get, or if you have to top it up. All right. And again, as first-time home buyers, it's not exclusive to first-time home buyers, but we can purchase with less than 20%. Back in the days when most of our grandparents purchased homes, they had to put 25% down on a purchase. Mind you, yes, housing prices were a lot lower, but the minimum was 25%. And so when CMHC and other default insurers came into the market, it then gave us the ability to get into a home a lot sooner than having to wait till we could save up that's 25 or 20%. Okay. What is the home buyer's tax credit? So this incentive allows home buyers to make a claim of up to $5,000 on their income tax for a qualifying home. And typically, a qualifying home is a home principal residence, right, that you live in. And then you would then get a $750 tax rebate. Okay, that's one incentive. The home buyers plan is for those who have RRSPs. So RRSPs are registered retirement savings plans. You can have them independent, or if you're working with a company, you can also have them structured with your company where you're contributing and they're matching your contribution. If you have any amount up to $35,000, this program allows you to withdraw your money to use as a down payment without any tax implications and without any charging you any interest. What will happen though is you do have to repay it, but you will have to repay it 2 years after you've closed on your property, right? And then you would just make 1/5 of the withdrawal amount over 15 years. So you have time to pay it back, and your income is not going to be, it's not going to count as income towards your taxes, so you won't be retaxed on that money, okay? For those who don't really understand what RSP is, it's a tax deferral program, meaning that if you save your money for retirement, because it's for retirement, if you save in a retirement fund, the government will reimburse you the tax portion of the money that you had paid. Because what happens is you're contributing based off of your net income, so your after tax dollars. So if you contribute to your RRSP savings, they will give you back the money that they had deducted from your taxes, from your paycheck. Tally wants to know, why do they minus 90 days when you try to get your RRSPs? It's kind of just like a rule. The funds have to be in the investment for 90 days before you can actually withdraw. It's just a rule. But if you are coupled, if you're married or even a partner, that 35,000 can multiply for both of you. So up to 70,000 per person can withdraw from on one purchase that you are going to live in. Right? Again, it has to be your principal residence. Okay. The third program, the first time homebuyer incentive program, is called a shared equity program. And this is where the government will match your down payment. So this program is you have to have a minimum of 5% of your own savings, and that can be from your RSP, that can be from just a traditional savings or investments. And they will give you an additional 5% if you're purchasing a resale property. But if you're buying a new construction property, they will give you up to an additional 10%. And so the whole premise of this program is to help you, one, cut time, right? For some, it would take them several years to save up an additional 5% or 10%. So cut time, get you into a home a lot sooner, but also by having a larger down payment, your monthly payments would also be reduced. The caveat to this is that you obviously have to repay it, right? Again, similar to the RSP, there's no interest, there's no fees attached to it. What they do is they secure that amount against the property. So now they're co-owners with you. You both share ownership in this property. And so you will have to repay what they've given you, whether it's 5% or 10%. At any time, either you are refinancing the property, you will have to give them back the 5% or the 10% based on the current market value of your property, right? Or if you're in the property for 25 years, you'll have to repay it then, or if you sell it, you will pay it then. So it is something that it has to be paid back, but it has to be paid back based off of the future value of the property. So you don't really know. And so in this example, if you purchase at 500,000 and they give you 25,000 to match your 25,000, it's still 5%, but 10 years from now, your property could be worth 600,000. When you are paying them back, you'll have to pay them 30,000. So that's an additional 5,000 that they've on what they've given you. Okay? This program is offered through the government, but there's also in recent news, I'm not sure if anyone here has heard, the government has delegated a set amount of money for the Black community. And that program, that version of the program is being run through an organization called Black North. If anyone has any questions or wants to know about it, I don't have any affiliation with it, but I can definitely send you the information on how you can inquire about that program. With that program, you are not required to have a 5%, but the repayment calculation is a little bit different. Okay. So again, there's so many opportunities for you to get into the industry. You just have to know what works for you and, partner with us and we'll help you to get there.
I just wanted to piggyback off of the RRSP situation,
Mm-hmm.
and you can tell me if I'm going in the correct direction.
Mm-hmm.
Now, say somebody doesn't have a down payment in hand. I'm aware of somebody who didn't have enough funds for a down payment. However, they went and applied for an RRSP loan,
Mm-hmm.
and then in turn used that loan for their down payment.
Mm-hmm.
And it still worked in the same way where they would have to do the repayment as far as the loan.
Mm-hmm.
But I thought that was a creative way to get a down payment in a situation where you are strapped for a down payment.
Mm-hmm. It's
What do you say about that?
it's definitely an option, and we've had several families have done that.
Mm-hmm.
The caveat to that is just ensuring that that loan, because you have to factor in the loan payment,
Mm-hmm.
right? Because in addition to repaying your RSPs, you'll have to repay the loan.
Right.
So that payment has to be inputted in your application. So as long as it doesn't impede your eligibility,
Right.
right? Meaning, like you're taking out a $35,000 loan, depending on what the monthly payment is, that could hinder your buying power.
Mm-hmm.
But it's definitely an option if the numbers work for you.
Right. If the numbers work. In that case, it did work.
Mm-hmm.
And it worked out only because they didn't have the down payment but they did have the ability to pay it back.
There you go. Yeah.
So and then once you build equity and you can, then, move on to your next home. Maybe I'm moving a little forward, but when you move on to your next home, that is something you can take care of with the bank at that time.
Mm-hmm.
And you still have equity to start your life as a real estate investor.
Absolutely.
Right.
Absolutely. Many ways to get into the industry.
Many ways.
Many ways. All right. So where do you start? The starting point is getting pre-approved. What does a pre-approval do? It avoids any hiccups or obstacles before you begin the home shopping process. Marsha, if you were to get a client that said, "Oh no, I haven't been pre-approved," what would you do?
Well, that's a that's a very easy answer. I would send them to you, because at that point it doesn't make sense to go and, get our hopes up and search for a home and we don't know how much we can actually spend.
Absolutely,
So
right?
yeah, pre-approval is key.
Very key. And so it does
Mhm.
it helps you to determine what your buying power is,
Right.
right? Because you're not going to buy a car if you don't know what your budget is. Why would you
No,
buy
it's
a home
true.
without knowing your budget is, right?
True.
It'll help you to understand what your monthly carrying costs are. So that's key. I stress affordability. The bells
Hmm.
and whistles are nice. The two-car garage, the pool, the jacuzzi, all of that is great. But if the dollars don't make sense, then it
That's it.
doesn't make sense, right? So understanding the numbers ahead of time is very, very, very key um,
Hmm.
in being successful at this real estate game. All right. Um, it also secures your interest rate. So we know that we're in a time where rates are moving, right? Rates are moving, but it's okay. It's okay. We're basically, on the tail end of the pandemic. And so what many people leave out of the news is that yes, rates are increasing, but where we are currently, we were just before the pandemic. So again, we're kind of like getting back to normal. Mind you, we're in a completely different state. Inflation, all of that are factors, but don't be deterred or feel like, oh my God, panicking because, you hear talks of interest rates moving, that, it's now or never. It's ideally now is the best time for you as long as it makes financial sense. But again, interest rates are interest rates and everything is going to always move. And so again, our economy is in a recovery stage. So everything is going to be impacted. Talia wants to know, can we use a line of credit as a part of the down payment? You can. Some lenders will allow that. It's called, could would be considered borrowed down payment. But again, anything that is borrowed has to be factored into the liabilities. So if that line of credit, if you take out $10,000, which your monthly payment now for that is going to be a minimum of $300, that $300 could cost you about $100,000 in mortgage money. So it has to, again, playing the numbers and making sure that that will work for you and not against you. But definitely some lenders will allow you to borrow down payment. Love the questions. And a pre approval helps you be confident in a competitive market. Marsha, do you want to touch on the competitive market that we're in right now? That is not
Well,
as competitive
yes,
anymore.
it we're just coming out of a crazy seller's market. And some people would be like, how? We're in a pandemic. How is it um so competitive? But it was. And basically, at the beginning of the year, we were looking at maybe 3,000 listings. Um, you know, buyers would have to sell a limb in order to get in. And it was just crazy. But now, things have increased. We went to 5,000, we went to 8,000. Now we're over 14,000 worth of listings. So what we're looking at is a better situation for buyers. There's more to choose from. Inventory has increased. So it has definitely improved for those wanting to get into the market. Sellers, when they would put their properties up for sale, they would be gone in a heartbeat. But now we're slowly getting back to where days on market would it would be like maybe 7 days at that time. Now we're getting back to the norm of like around 25 to 30 days. So, things are getting back to normal. And buyers should become more confident when they go out to look at homes, and you know be confident that they don't have to um
Fight.
yes, they don't have to fight to get into where they want to get in.
Right. Good. Thank
Yeah,
you.
and I always say get in where you fit in. You don't always have to buy the mansion up front. Get in where you fit in and somehow work things for a little bit, and then when you're able to leverage, you move on.
Right. Thank you.
Mhm.
So a reminder for everyone is that the process is personal, right? Not because, Tom and his wife, very, very bad name choice, but you know what I mean, purchased a home in this market means that you can, or even that you can't, right? This has to be about you and where you are financially, right? And so again, the first thing that we do is we determine what your goals are. Most first time home buyers buy based off of emotion, right? They want to live in their home that they purchase, which is nothing wrong with that. But again, with the times that we're in, sometimes we have to change or restructure our strategy, right? And not buy from an emotional place, but more of a strategic business place, because real estate is a business. Anything that you put money into and can get money back plus some is a
Business.
business, right? So we want to assess what your goals are, short term and long term. We assess what your budget is. I stress affordability. It has to make sense. As a mortgage broker, when I'm using your details to qualify you, I don't factor all of your lifestyle expenses, right? As moms, we have not only personal expenses or house expenses, we have children expenses, right? Sporting
Mhm.
events, teams, all of that stuff that we have to pay for, which we don't factor in the qualifications. So knowing what your budget is in terms of your mortgage power, but also aligning that with your current household budget is very, very key. It has to be able to blend and not cripple you in order to get into the market. We review your family needs, and I stress needs, right? And then your wants. Where we are, not like when I purchased 20 years ago, you can get something for 100,000. Not the case. right?
Mhm.
So the whole idea is to get in, like Marsha just said, get in where you fit in and let the magic of real estate do the rest, right? Your first property ideally will never be your dream property, right? It's the way to get in so that your money can grow and position you to then move on to your next home or an investment opportunity. Tally says, what are your thoughts on a condo townhouse for a first time home buyer? I'm all for it. And we're going to go into some examples shortly. I'm all for it because if that's where your budget gets you, get it.
Mhm.
Get in where you fit in. I don't know how other, like, I have to stress that. Get
Mhm.
in where you fit in, right? Um, and again, do what you got to do in order to get in. So if you're not able to do it on your own, partnerships, co-ownership, family, friends, it's a business, right? Get creative. And then we create your blueprint, right? What do you need to do in order for you to take action? All right. I like to call this the three pillars of an approval, right? It's we factor in your income, we factor in your credit and your debt, and your equity, otherwise known as your down payment. So as you're preparing, as you're thinking about it, these are the things I want you to focus on, that you're getting in alignment, you're increasing, you're working on areas that you need to focus. So it's not just about the home, it's about, your little internal financial house too. Okay. Income, of course, if you're asking somebody for five, six, $700,000, you're gonna have to show how you're going to repay, right? So they want to know, lenders want to know, where is your income coming from? Are you working as a full-time employee? Do you get paid by the hour? Are you self-employed? Are you a business owner? Various types of ways that we can earn income. We just have to provide documentation so that they can feel comfortable that you can afford what you're asking for, right? The documentation list is here. Typical stuff: job letter, pay stub, taxes. If you owe taxes, it's a good idea that you bring your taxes up to date, right? If you owe CRA, lenders will not want to touch you because CRA, is the boogeyman. So making sure that your taxes up to date, and that you have documented income. Business for self people, it's a little bit more challenging in terms of quantifying your income. As self-employed people or commission people or business people, typically we work and we earn, but then come tax time, we try to bring our income down so that we are paying less taxes. And so in terms of mortgages, we have to use documented income. So the income that you declare, right? So if you are business for self, we might have to restructure going forward how you expense your income, so that you make sure you're proving that you have more income that gives you ultimately more buying power. Okay. There was a question. What about OSAP loans? What about OSAP loans? You can have loans as long as your loans are in good repayment. But again, any liabilities that you are making monthly payments on, we have to factor that into the qualifying criteria, which is coming up shortly. Okay. Credit. Everyone knows about credit. Credit is for the mortgage process. As I said, you're asking the bank for five, six, seven, 800, maybe even $1 million. Their only way for them to determine whether you are a suitable candidate is by, obviously, your income, show that you're working, but also your credit. They want to see what your relationship with debt is like. How are you making those payments, right? So your credit history is very, very key in the application process. In terms of credit scoring, know that the credit score is not the end of the report, right? It starts with the score, but the score is a reflection of what the behaviors are throughout the monthly basis, right? When your things are reporting. So having a credit score, a minimum of 650, the higher the better. You want to aim for 60, 680 and above. If you are not there, you can definitely send me a message and we can schedule a consultation call, and I can let you know what you need to do in order to increase. Again, it's not just the score, but again, what happens in the activity of your accounts determines your score. So there's things that you can do to make changes. You want to have a minimum of 2 to 3 years of established history. Just today, I spoke with someone who said, oh, I had a card and I canceled it because I got a new card. I was like, why? Because she has just started building her credit, and now she, instead of having two credit facilities, she only has one. And so because one is canceled, essentially she's only going to be showing history from the open account. We got to have 2 to 3 years of history with a minimum of two active trades. So that could be two credit cards, that could be a credit card, a car loan, that could be a student loan. Student loans don't help you really, but they can hurt you if you don't pay them. But having them there does show some form of responsibility. um, Lines of credits, personal loans, anything that is reflecting on your credit can help you to show your relationship with credit. A minimum of 5,000 between all accounts. Credit is something, especially over the last 2 years. I know that, when things are tight, life happens. Credit is the last thing on anyone's mind. And so we do understand that in the industry. So if you have had to go into a proposal or a bankruptcy, don't feel that you are ruled out. There's definitely a time where you can redeem yourself from that and qualify for a traditional mortgage. Or if you have, a large down payment, you may be qualified through a non-traditional lender. Okay. So there are options. All right. But credit is definitely a key indicator in the approval process. This is kind of like the unspoken criteria that a lender goes through when they're assessing your application, which is called the 5 C's of credit. The collateral, the property, they do factor in. So again, there's a couple stages in this approval process. They want to make sure that you're okay, but they also have to like the property too. The property has to be marketable, because they're always thinking from the end game. If this person doesn't repay, something happens, how are we going to get back our money, right? So they're looking at the property. Again, with the credit, they're looking at your history. If you did have an issue, as long as we can explain it and it makes sense and they're comfortable with that and you've redeemed yourself, that's good. Your capacity, are your debts maxed out, right? Are you overextending yourself? That also reflects on your credit bureau. Your down payment, it's always best to have some form of skin in the game, which is why many years ago Canada eliminated the no down payment option. I know many people would like to get into a home without having a down payment, but again, they're looking at their risk, right? If you have nothing invested and you lose your job, you're not going to be concerned with the home. You're thinking about you and your family, right? So you got to have something to bring to the table. And again, that can come from many different sources. And then your character on a holistic level. If you have stable income, if you're managing your debt, you have savings, you have investments. These are the things that lenders like to see when they're assessing your application. Terry wants to know, does a voluntary repossession work against you if a car was a lemon and turned into a loan when it died? How does it reflect on your credit bureau? That's key. Because if it was a lemon and it was a voluntary repossession, um, is it showing on your credit as delinquent? Right. So it depends on what it's reporting as on your credit, showing as delinquent. So yeah. So one, I would say challenge that, especially if it was voluntary because the car didn't work. Two, how long ago was it? Is it something that may be purged soon? Three, the how is everything else, right? They're looking at everything, and if there is a bleep on your credit and it can be explained with justification and documentation, then possibly maybe not the top tier lenders, but maybe the second tier lenders would. About 2 years ago, everything else is good. Okay, so we can take a look at it. Again, again with us, we have different lender options. So one lender may be like, no, but another lender will be like, okay, as long as she can provide confirmation that this happened and this is what happened and X, Y, Z, then you definitely could have an option. Okay. All right, some quick credit tips. I can't believe it's so late already. Always pay your bills on time. The minimum payment 5 days before the due date. But if you have the opportunity to make extra payments, make a few extra payments before your statement date. If you're not sure what that is, look at your monthly statements. It'll say a print date or a statement date, and it'll say a due date. All right. Keep your balances super, super, super low if you can. 30% is the sweet spot. What that means is if you have a $10,000 credit card, you don't want your balance to be any higher than $3,000 when that bill is being printed or reporting, so the statement date. If it's not, that's fine. Work your way to bring it down, because every dollar that you're paying towards debt is a dollar that you're taking away from your legacy. I mentioned again 2 years history with a minimum of 2 active trades. So if you only have one, because old school parents, they're like, no, I don't want a credit. Listen, credit is a leveraging tool if used correctly. All right. So as long as you know how to use it wisely, you can use it to help you get ahead. Major credit cards are best, right? You say interest rates can be lower. Be mindful of any unused accounts, right? And thing that has annual fees. You may think that you've paid the balance, but there's an annual fee and you've forgotten it because you're not using the card. But if you're not making the payment for that, that could hurt you. Apply for credit only when you need it. Now, there's a lot of different scenarios out there. They say, well, of course, use your credit. They're offering you credit, take it. But unless you have a good handle of money management, I say if you don't need it, you don't need to accept it. All right. Of course, everybody's cases, individual cases are different. So, but that's my general rule. If you don't need it, don't accept it. Avoid closing or canceling any credit accounts, as I mentioned. The longevity of your credit works better for you because it helps with your score. So if you do have just 2 years, or you have a card that you've had for 10 years that maybe you never really used it, that works best for you. All right. And so be careful of co-signing for others and reserve that option for joint ventures, partnerships, co-ownership, because even if you sign for your brother's car and you're not paying for it, it's showing on your credit report. And so as you're purchasing, we do have to factor in that entire payment into your liabilities, and it could impact your eligibility. Secondly, if he doesn't pay it, it's going to hurt your credit. So it'll also impact your eligibility. So be very mindful on co-signing for others. Lastly, equity, the down payment. Banks want to know, again, where your skin is coming from, right? Traditional savings are acceptable. Non-traditional, padna suso, it needs to be documented, okay, folks? It needs to be documented. And I'll caveat that with saying it also needs to be earning you interest. How do you calculate your closing costs before closing date? Closing costs is an estimate of the purchase price. Typically, lenders want to see 1.5% of the purchase price. But as a first-time home buyer, as I mentioned, you're eligible for some credits, so we can factor that in. So it depends on the purchase price amount. It depends on your status. If it's a new construction, it could be a little bit higher because they have additional fees on top of fees. So roughly 1.5% to 2%, or about 1% if you're a first-time home buyer. Gifts are acceptable from immediate family members, and immediate family members are brother, sister, mother, father. I had luck one time when it came from an aunt. Lenders like it to be coming from a very, very small circle, and it has to be documented again. The RRSP plan, as I mentioned earlier, the shared equity plan, affordable home ownership programs, which is essentially the same thing. And we talked about the borrow down payment. You can borrow your down payment. Again, everything has to be documented and also factored into the qualifying criteria. How do we calculate the down payment amount? So if you are purchasing a property up to $500,000, you are eligible to buy with 5% down. If the property is more than $500,000, you will pay 5% of the first 500 and then 10% of the difference, as someone asked in the chat before, right? So if the property is 600,000, you will pay 5% of the first 500, which is 25,000, and then 5% of the $100,000 difference, which is an additional $5,000. So a total of $30,000 plus your closing costs. Any property that is over $1 million, the minimum down payment requirement is 20%. Okay, so on $1 million property, $200,000 is the minimum. All right, and these are for owner-occupied property, so principal residence property that you are going to live in. If it's an investment property, a rental, the down payment minimum is 20% of the property price, no matter where it is on the scale. If you're self-employed, depending on how your income is documented, your minimum may be 10% as well. All right. I think I'm in the final stretch. How do I determine how much purchase power do you have? So there's two indicators that we use to calculate your buying power. And they're called debt servicing ratios, right? So your GDS, right, for short, or your TDS. Your gross debt factors in the mortgage payments, right, which also consist of the principal and interest portion, right? Remember I said you're paying yourself every month. Property taxes on a monthly basis, heating costs if it doesn't include it, right? So if it's a house, typically we use about $125 per month. If there is a condo fee, we chop that in half and factor that into the application, and we divide that by your annual income. We use gross income to qualify. So that's also something we want to factor, that it's not after tax dollars, it's before tax dollars that we use to help you qualify. And so that debt service ratio cannot exceed 39%. And so this applies specifically for mortgages that are insured by the insurance company. So if you're putting down less than 20%, okay? And then your total debt service also factors in everything that's on the GDS side, but any debts that you have. So anything that's reflected on your credit bureau, car payments, credit cards, lease payments, all of those things. And so once we divide that by your income, the maximum is 44%. 99% of the traditional lenders are very, 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 very strict when it comes to the debt servicing ratios, and really don't like when people are, say, maxed out on their debts and maxed out on the ratios. So again, it's knowing the affordability, knowing your numbers, know what you can adjust, or not really buying at the top of your budget. Okay. Something I didn't mention was the stress test. Anyone ever hear about the stress test? All right, so the stress test is also what we have to plug in to calculate these ratios. And so what that is, it's an interest rate that's a little bit higher now. It's a little bit higher than what you actually would pay on the mortgage, but that gives you a little buffer should interest rates increase like how they have. They want to ensure that you're not overextending or buying at your absolute cap. Okay. What considered to be a good DSR, debt service ratio? Well, as long as it doesn't exceed these, you're okay, and you're comfortable with the payments, right? But again, typically lenders would prefer that you're not maxed out on your cards and you're buying at your maximum buying budget. But anywhere that is comfortable for you, as long as it doesn't exceed these, we can get you an insured mortgage. And so for those who just want to quickly calculate how much they may qualify, there's a qualifier shortcut. If you use your annual income, right? And so your annual income doesn't necessarily just mean you. It could be anybody you're purchasing with, your partner, your wife, your husband, business partner. Multiply that annual income, the gross, times 4.5, and that'll give you a very, very, very simple estimate as to how much mortgage money you can get. So if your income is combined income is 100,000 or income is 100,000, multiply that by 4.5, your mortgage amount would be roughly for 450,000, and then you add your down payment on that. So if you have 100,000, your buying power would give you about 550. Very, very, very simple calculation. Does not guarantee that that's what it is, because we don't factor in your debts and all of that stuff, but just to kind of give you an idea. All right. So don't say I pre-approved you for 450 without having a conversation with me. All right. Can you refuse mortgage insurance if you have life insurance? Mortgage insurance. So there's different types of mortgage insurance. I'm not sure if you're speaking on mortgage life insurance or mortgage default insurance. Mortgage life insurance is definitely optional because it only covers the mortgage, right? Should something happen to you, if you pass away, if you are unable to work, it has critical illness and as well, or disability, as well as critical illness and disability, right? That is definitely optional. But if you are purchasing it with less than 25%, unless you can pay for the default insurance, the default insurance is not optional. It gets added to your mortgage because by law, banks cannot lend more than 80% of the property value without having default insurance. So if you're talking life insurance, yes, mortgage life insurance, you can definitely refuse that if you have your own life insurance. All right. I'm done. It's your turn, my girl.
Well, here we go again. Alrighty. So I want everyone to lift up their right hand and stretch it over and pat yourself on the back because we have now past step one. So you've met with a real estate professional, and we have already started the journey along our buyer's roadmap. So I applaud you all for taking the step to join us this evening. I know you could have been doing something else, but this is really pivotal as far as getting your journey started. So I really applaud you tonight, and I appreciate you taking the time. The next step, as you know, is to get a pre-approval. So hopefully you will be booking an appointment to speak with Siobhan to figure out the fine details as far as what works for you and works for you and your family. And then we would get to the step three, which would be to search for homes. So the fun begins at step three. And I wanted you to think about, like we discussed in the beginning, what is it that you are really looking for? We would look for your desired location. Do you want to live in downtown, the suburbs, a more rural environment? Does the neighborhood have a look and feel that suits your style? You know, think about what it is that you would like. Is it around school, shopping, recreation facilities, health services, those kind of things? We also look at size. How many bedrooms and bathrooms do you need? Do you need a home office? Do you need extra storage? Do you need a garage? Special features would include air conditioning. Hopefully the weather has started to improve, and I'm quite warm as I'm speaking to you right now. So it might be time to put on the AC. Um, some people spoke about getting a pool. Is that something that is on your list? Does any of your family members have allergies, environmental sensitivities, special needs? These are things that we consider. Lifestyle, are you planning to have any children down the road? Do you already have children who will be moving away soon? Things of that nature. So we take all these things into consideration when we're going to look for your next home. Um, the next step would be to think of forms of ownership. What kind of ownership suits you? There are freeholds. You own the building and the land that it rests on. There are leaseholds. You own the building or unit and rent. Sorry about that, guys. I don't know why my phone is going off here. But yes, you own the building or unit and rent or lease the land that it sits on. Are you looking to get into a condo, or the other name for it is strata? This is where you own your unit and share ownership of the common areas with other unit owners. Did you want to get into a co-op? So instead of purchasing a specific unit, you buy a share in the entire building and are assigned a unit to live on. So mostly I work with people who are interested in freehold, leasehold, or condos. Alrighty, so these are different things that we look at when we're deciding to get into the home ownership game. After we've decided that and we go and search for homes, we find one that suits our desires, we then make an offer. Now, as we know, it's been a crazy time to buy, but it has now started to improve. So do you decide to make an offer based on the price that's given? Do you make an offer over asking? Do you make an offer under asking? So we would sit down and discuss what would be the best strategy at that point. We then move on to negotiation and forming a contract, hopefully, and let's not even say hopefully, once it is approved and accepted, we are now in escrow. So we, at that point, get all our paperwork together. We submit our down payment. We speak to the lawyers. We do everything that is necessary to get everything signed on the dotted line. We deal with the final details at that point, and then we move on to closing day. And that is when you receive your keys. We do all the final signing, and we share a glass of sparkling grape juice. So hopefully we reach to that point at closing day, and then you start your journey towards home ownership. Is there a next slide? Right. So we did discuss with Siobhan all the things that would be necessary in order to confirm if you are ready to buy. So she did speak about you having a steady income, low debt, your cash for down payment. You want to ensure that you have at least a 5% down payment. Again, that would excuse me, I'm busy. That would then ensure that you would have to be under CMHC for your insurance as far as your mortgage down payment. We'd also, as she said, your credit score and your bank statements, all that good stuff, she will handle that. And once you're ready to buy, we then move on to the next step. Right, so we did discuss, we'll be looking into location, price, how big of a home. A lot of us would love to live in that mansion on the hilltop, but sometimes it's better to start at a more modest step and then move on up to where your forever home would be. We would discuss how many bedrooms, how many baths, the type of style that you're looking for, the features, and the schools. If that is one of your criteria, we would discuss those details and then take it from there.
Oh, okay. Here, you're gonna go through this, but I have a question though. Donna has.
Right.
Can you explain how equity mortgage work and would a first-time home buyer qualify for this? What do you mean a whole equity mortgage, or do you mean a home equity line of credit? Is that what you're referring to, Donna?
No, I think when you started off, you make reference to home equity mortgages. So I'm not too sure what that is.
Oh, I was referring to equity, as in your equity is what your down payment is. That's your portion of the investment.
Okay, got you. Sorry.
No problem, no problem. Stella's asking, what is the best down payment to have? It depends on your affordability, right? So the more, the better, because the higher down payment you have, the less default insurance premium you have to pay. And of course, the less your monthly payments will be as well. So the maximum that you can save in the quickest amount of time would work best for you. All right, so we pulled up a couple different properties, 3 to be exact. I took a few slides. We have a condo high rise, a condo townhouse, and then a duplex. So I did just print. Can you hear me? Nobody can hear me? Hello, hello? Can you hear me, Marsha?
I
Oh,
can hear you.
hear you.
Okay. Teresa must be turn up your volume, love. Okay, thank you, Christopher. So this property is in Mississauga. And so we just did a quick snapshot of what the numbers are. This is a listing price. It's a 2-bedroom condo um, that, of course, Marsha can help you to look at if you're ready to look at. The list price is $700,000. The annual property tax is $2,010, which would be divided on a monthly basis, of course. The monthly maintenance fee is $899. Um, and the mortgage payment would be about $3,500. And now this calculation is based off of a 10% down payment, because remember, it's over 500,000. So 10% amortized over 25 years using a 4.2% fixed rate. All right. So that's what this property would kind of cost you. The next one is a condo townhouse in Brampton, and this is a 3-bedroom condo. I think somebody was asking about condo townhouses, so this would be a nice property for you to look at if you're in Brampton. The list price is 800,000, 799.99.
Mm.
Property tax is about $3,500 for the year. The condo fee is 157. So the difference between the high-rise condos and the condo townhouses you'll see in the maintenance fee is because the condo covers all of the common areas, so the hallways, the laundry room, the driveway, the garage, like all of those things. The condo corporation manages those things, and take upkeeps them. So snow shoveling, cutting of the grass, things like that, right? And most times in high-rise buildings, that maintenance fee also covers your utilities, so your light, your hydro, gas, water, right? That's why you would find that those maintenance fees are a little bit higher. And also the age of the condo would also make a difference as well too. In a townhouse, there's less responsibility put on the corporation, so you're responsible for pretty much everything. They're only responsible for the driveways to enter into the condo area, right? So the maintenance fees are a lot lower, and you're getting also more property, so you have to pay your utilities on your own. So sometimes it kind of works out the same, but you have more space and again more freedom. Daslin is asking for an explanation on freehold townhouses, please, and I'll let you do that.
Freehold townhouses. This one is actually, as a caveat, an aside, this one has a finished basement too. If anybody's interested, let me
Oh,
know.
okay.
But freehold townhouses are basically what you're looking at. You're responsible for the cost and maintenance of the property, but you also have full use and control of the land and the building. And this is subject to any rights of the Crown or local bylaws or any other restrictions in place at the time when you purchase the property. So you have a little bit more freedom, I guess. When you listen to the word freehold, you have a little bit more freedom when it comes to a freehold property as opposed to a leasehold. So you own the building and the land that it rests on.
And so therefore there's no additional maintenance fees.
Exactly.
Right.
No maintenance fee where that is concerned. This one we just looked at has a maintenance fee of 157.81. So, there's certain ones townhouses that you do buy that you don't have maintenance fees on. So you are responsible for maintaining that property. So that is the main difference between the two.
Awesome. Thank you.
You're
And so on
welcome.
this property, the mortgage payment would be roughly $4,000, 39.85. And again, this is based off of a 10% down payment, amortized over 25 years at 4.12. You're welcome, Deslin. And lastly, now these are some good shots, right? And so remember I mentioned earlier that based on where we are in the market and possibly where you are, you may not be able to or may not want to be able or purchase a property to live in, right? You want to be more strategic and participate in the business of real estate. And so this property, and why I asked Marsha to pull up a property like this, it's a duplex. And so like the first property, the condo was listed at 700. This unit is listed at 700 as well, but it's an income property, right? You could opt to live in one of the levels, right? It's a bungalow, I think it is, right? You can opt to live in one of the units and rent the other, or you can opt to rent out two separate units. And what that would do is obviously double your revenue and therefore cover your mortgage costs,
Mhm.
right? And you would probably pocket the rest, right? So listed at 700, property taxes are 20,000, 2010. Oh no, dang, that's wrong information. This does not have a condo fee. but so I didn't take off the condo fee, but it was definitely a $700,000 listed property, and the mortgage payment would be about $3,500, right?
Right.
But again, it positions you one to not only get into the market. It may not be aesthetically your idea of a home, but again, once you own, this is freehold, so there's no condo fees or whatever, so you can do what you need to do. And I'm going to assume that because of the listing price, that it's priced because they know that whomever takes it is going to do some work on it, give it some
Mm-hmm.
zhuzh, and use it as an investment property.
For sure. It'll need a little bit of TLC, but it is, as you said, an investment. You have to come in with an investment mindset.
Mindset, absolutely.
So it is in a wonderful area, Weston Road and Shepherd. So
Close to where I
it's
grew
a,
up.
yes, I love that area.
Mhm.
And it's a well-loved home, but again, it would require a little bit of TLC, and you can flip that in order to get your foot in the door.
And so going back to like joint ventures and partnerships, if you have a sibling, if you have a partner, right, this could extend your affordability,
For
right?
sure.
Two families can live in this for a short period of time, allow it to appreciate in value, and then in a short number of years, you can resell it and then move your way. Take split the profits and move your way, move on your way. All right. So again, as a first-time home buyer, as I said earlier, most of us we think from an emotional standpoint and want to buy the home that's going to, satisfy our personal needs, which of course you should. But I want you to also remember that real estate is a business. And so sometimes you might have to be strategic in order for you to get in. But we want you to get in where you fit in and let the real estate magic do the rest. All right. I think.
Yeah. This last one, okay, yeah. It's okay. We'll leave it at that then. Yeah. It's a little bit more than that, but not much more.
Okay.
But it is definitely, as you were saying, there are other cultures that, take interest in working together and pooling resources in order to better the entire family, so to speak. So it is an option that people should, look into. It is a viable option. Make sure you dot your I's, cross your T's, make sure it's in writing. But yes, it is something to look into. Somebody has 20 grand, another person has 20 grand, another person has 15. We just got out of tax season. It is something to investigate if that is the road you want to go into.
Awesome. I think that's it because this next slide, we talked about that already, right?
Yes, ma'am.
And then that. Oh, this one. I want you to talk about this one
Okay.
as we close up.
Right.
We're about done.
So closing costs, as we discussed, between 1.5 would probably be your good spot to be in as far as preparing for that. And in that closing costs, you would include everything from your appraisal to the home inspection. Sometimes, yeah, that is, yeah, home inspection is included. You have your processing fee, underwriting fee, recording fee, title insurance, document preparation fees, transfer taxes, and attorney fees. So the lawyer would sit down with you and go over and make sure everything is taken care of where that is concerned. It's not something that you would have to be writing checks for each item. It is something that is taken care of when you sit down with your lawyer. And we do provide that referral for you as well, should you need to have a lawyer to take care of the final closing cost breakdown.
Awesome.
Mhm.
Christopher's asking for a good tax person. Send me an email, Christopher, and I will definitely connect you with someone.
Mhm.
All right, I think we are because it's closing day. Hello.
It's closing day. Yes. So at closing day, I will ensure that we have taken care of the closing, answer any questions that you may have. We'll go over the closing paperwork and the purchase contract. You'll make sure you have your identification with you, and everyone who will be purchasing or is purchasing the property should be present. We'll discuss that if it's not possible. You would need to bring a certified check or wire your down payment and closing costs. And as I said, we would hand over the keys, we'd do a little dance, and we'd be off to your home. And I believe we have a chef in the midst. He could, he could definitely invite us over for a little meal.
Right.
So yes, it would definitely be a time of celebration. And I salute you all for taking the first step to getting to this point in the home ownership game.
Awesome. That I think that wraps up everything. And in closing, folks, in closing, don't wait to buy real estate. Buy real estate
Real estate and
and
wait.
wait.
That's it.
Buy real estate and wait, right? Get in where you fit in. Let real estate do its magic. Give yourself and your family an opportunity to position yourself for financial greatness. Real estate, again, is one of the most secure ways to have your money invested and allow it to grow at an exponential rate.
Yes.
We know, you know, aside from COVID times, right, when people are, they're appreciate properties are appreciating at, record speeds, but in real estate, on average, your money will grow 5, 6, 7, 8% every single year.
Mm-hmm.
And there's no savings account that will give you that amount of money.
It's
None,
true. Very
right?
true.
So don't wait to buy real estate. Buy real estate and wait. Marsha and myself are here ready and willing to aid. Yes, I will definitely send you the recording. I will share it with the list afterwards. Thank you for asking. Um, are here ready and willing to support you. All right, I'm gonna stop recording.